Good morning. It is Wednesday, December 7th here in New York City. This is Yahoo Finance Live. I'm Julie Hyman with Brad Smith and Brian Sozzi. And let's get right to the three things you need to know as the clock hits 9 a.m. Let's take a look at futures sliding today after another tough session on Wall Street yesterday. Investors fretting that the new year might bring a recession. We've got the gloomy outlook ahead.
And optimism out of China, the country dropping many of its quarantine and testing requirements despite COVID-19 cases still continuing to rise. We've got the latest on that front as well.
It's even darker before the dawn. More gloom and doom for 2023. Morgan Stanley economist Seth Carpenter joins us with his outlook for what is expected to be a tough year for the markets.
So we begin today with our top story. Sentiment is low on Wall Street for another down day here, and after another down day rather. The S&P 500, you saw the worst sell-off in a month, reversing the rally that followed Fed Chair Powell's comments on smaller interest rate hikes. Oil also hit its lowest level since last December, with WTI erasing all of this year's gains. And it just continues to come out, not just in the sentiment and how the markets are reacting, but also what they're reacting to. And we've got even more commentary from CEOs, and some of that still echoes what we had heard on earnings calls. We remember just a month back, or at least at this point, about 2 months ago, where Jamie Dimon of JP Morgan had said on their earnings call that this is an environment that is odd. You've got consumer spending that is still very strong, and that was showing up in their numbers. However, you're still seeing this predictability of a recession, and how mild that recession is what the market continues to latch onto and what that looks like. And he's saying that this is probably going to happen, or at least back then said it may happen in the first quarter of next year. But the severity of that recession, we're getting even more commentary around too.
Right, Brad. I think this is the CEO sell-off that we're seeing this week. And I think you have the likes of Brian Moynihan, you have Jamie Dimon, you had Doug McMillon, you had a lot of CEOs out there yesterday presenting at conferences, doing interviews, I think setting investors up for what they might see when fourth quarter earnings reported and things are guided to in early January and later January, that maybe they're not as good as the market was pricing in about a month ago. And already we're starting to see the likes of, I believe it was Bank of America, Julie, missed on their net interest margin. They pointed that out at a conference yesterday as well, huge red flag.
And of course you have cutbacks happening as well. Morgan Stanley cutting 2% of its workforce, adding to what we heard about Pepsi yesterday, and then of course the cuts that we've seen in big tech as well. And all of that equaling the S&P 500 now at its lowest since about November 9th. So these sort of feints that stocks have been making at a rally that a lot of strategists have said, well, it's just a bear market rally. It does seem, at least for now, that has been the case with this looming potential recession over investors' heads. So all of this to consider. We saw a lot of the groups that have that are more cyclical, you could say, that underperformed yesterday. Energy, of course, still the best performer in the year, led declines along with communication services and tech and consumer discretionary. Those were some of the worst performers.
Yeah, a lot of those meme stocks also got sold off as well. Those higher risk names definitely are coming under pressure here. All right, China is doing away with its zero COVID strategy and dropping test requirements for some public places in a dramatic shift following a wave of protests. Yahoo Finance senior healthcare reporter Anjali Kamlani is here with the details. Anjali.
That's right, Brian. We had heard inklings of this happening, and now it actually has happened. China now removing some of its most stringent policies, but still maintaining some restrictions as it tries to continue to curb the virus. As we know, cases continue to rise in some of the major metro areas, but some of the changes that are now in place are a reduction of testing, especially no requirements for proof of testing in public transportation or in public spaces, as well as a reduction in where people are isolating or how they're isolating. Previously, if cases started to rise, entire cities were locked down, some neighborhoods. Now it's just going to be limited to buildings, units, or floors. We also hear about a reduction of the requirement to provide ID when buying certain medications, to contact trace and the like. There's also been a reduction in the contact tracing as well. First of all, the layer of people or sort of the degrees of separation of people has been reduced over time. And now in addition to that, we know that people can isolate at home rather than in some of those makeshift facilities unless they are elderly or pregnant or more vulnerable and do need that separation from people. So all of these are significant changes. They're also moving away from PCR testing in general in high risk, in all but high risk areas, and a reduction in PCR use as well. So all this really freeing up some of the resources that were being put into some of the these restrictions coming, of course, after the recent protests, as the country has been under really stringent lockdown for the past 3 years.
At the same time, Anjali, investors who are perhaps optimistic about a total reopening in China might just be cautious here, because what we're hearing in terms of reports out of that nation is that it's messy, this whole process. In other words, while some of these restrictions to enter certain areas are removed, they're still in place for others. And if the testing apparatus is going away, but you need a test to still get into some areas, in other words, it seems like there's some confusion on the ground there.
That's correct. There is still a lot of sort of changes that are still ongoing, and it's varied how well they're being put in place. We know that earlier, basically last week, when there were talks about this and some of the reductions in policy, you saw a change in some of the major metros picking this up, and then maybe some other areas not being willing to follow the rules just for fear of the ongoing spread. And of course, this is coming at a time where we know the winter season, the time of year where respiratory viruses do thrive, and so that is definitely where some of the concern comes from. It is a messy situation. It's also interesting timing. And so experts are warning that it's going to be a pretty tough sort of loosening or reopening ahead.
Anjali, we're also seeing some new data on the Omicron booster shots in the U.S. What's the latest there?
That's right. There was a study that just came out that discussed the BQ.1.1 variant, and that's the variant that is starting to take hold here in the U.S. is dominant compared to the prior BA.4, BA.5, which is where the vaccines are now targeting the new bivalent booster. So a shift has come there in terms of the discussion of what is needed to help further protect, especially the most vulnerable in the population. A study pointing to the reduced efficacy of the original vaccine against BQ.1.1 only in antibody production. And I want to point that out because that is the crux of a debate that has been ongoing in the public health community about whether or not the original vaccines do still hold against severe disease and death, which they seem to do. However, we also know that Europe just recently put in place a new rule that the initial vaccine, not just boosters, but initial vaccine is going to shift to the BA.4, BA.5.
Oh, it looks like we've lost Anjali for now, but luckily she got most of that in. And as we talk about what's happening in China, what's happening in the U.S., the common theme is that things are slowing down from an economic perspective as the world economy faces one of its worst years in 3 decades. Our next guest says we're on the cusp of a loose recession. That's Morgan Stanley chief economist Seth Carpenter, and he is with us right now. Seth, it's great to see you. Obviously, there is a lot of glum talk that is out there. First of all, what does a loose recession mean?
What that means is when we look around the world and we think about the global growth rate, there are lots of countries, especially EM countries, that just are growing more rapidly on average because they're starting from a lower base. And so to use negative growth to define a recession globally sort of overdoes it a little bit. At the end of the day, though, it ends up being semantic. It's something a recession, if we're growing at positive 0.5%, if we're growing at negative 0.5%, that matters a bit, but we're in a situation where things are slowing down so much, the distinction between recession or not is going to be a little murky.
Seth, you're not looking for much growth in the U.S. next year. Walk us through what that growth looks like. What does growth look like in the first half of next year, for example?
Absolutely. So slowing down in the United States is, as it turns out, the objective of the Federal Reserve right now. They are raising interest rates, and we'll have another meeting coming up next week. They're raising interest rates precisely to slow the pace of spending and to get the economy to slow down. We think they're going to be successful, right? We see a housing turnover. We're seeing some hints that durable goods spending is starting to come down. That's what they're looking for. So we think we get a slowdown. If you take jobs, for example, the last print was still pretty solid at mid 200,000. We think that continues to come down and eventually starts to get below 100,000 per month. We think it stays positive on average. So again, skirting a recession, but it's got to come down from where it is now if the Fed is going to be successful in bringing inflation back down.
So real quick, is GDP negative in the first quarter and the second quarter of next year?
We don't think so. We think it's going to be positive. We think it's going to be, about 0.5%, something like that. So skirting a recession, just barely avoiding a recession. We're still cautiously in the soft-ish landing camp.
So the Fed can say one thing and Powell can put out one message through a speech, through testimony, whatever that may be, but the markets can read something totally different and decide what they want to think about what Fed Chair Powell and some of the other committee members are saying. Does the Fed have a communication issue at this point, or is it how the markets are actually digesting what the Fed is signaling?
Option D, all of the above. We are in an extraordinarily difficult time to predict what's going on, to understand where the cross currents are. The news coming out of China that we just discussed, that's a rapidly developing story that has lots of implications for markets. And I think there really is inherently a lot of difficulty in understanding what's going on. When folks from the Fed talk to me about exactly this question and they say, what should we be thinking about for communication? I say, and at first they think I'm being flippant, but I say you should be as clear as you can be, but don't be any more clear than that. And there's just so much uncertainty right now. I think they need to be cautious in what they commit to.
Yeah, there's almost a danger of over-speaking. And I guess Jay Powell took that lesson to heart at Jackson Hole this year. But people are going to react how they're going to react. I do want to broaden out the conversation a little bit and talk about China, talk a little bit about the Eurozone, where we just got a better than estimated revision in GDP this morning. Sort of how lumpy is this going to look around the globe? Are there areas that are really going to hold up better?
There are almost surely going to be areas that will hold up better, but it will be messy, it will be lumpy, and there will be a whole set of confusing news flow. So for China, the news that we were just discussing is about what's going on with reopening. And I think one of the questions you asked is, what does it really mean? If there are restrictions lifted in some areas but not others, will people know what to do? I think on a global economic scale, there's also the question is, when the economy opens up, what does the demand look like there? And we know that households have been sort of locked in for a long time. The pent-up demand is probably more skewed towards domestic spending than it is historically, more skewed than typical towards services. And as a result, there's probably going to be less pull in terms of imports into China from the rest of the world. So I think the normal spillovers we get from a China acceleration are probably a little bit smaller this time than they have been historically.
Well, and the other question I would ask is, as we see sort of that last big economy reopen, have we learned the lessons from here? In other words, here we had all these pull-through effects and all of these strange effects that are now recorrecting and renormalizing. And we sort of knew it was coming, but we also sort of were surprised by it as it came, right? That we have seen these strange dislocations. Have we learned the lessons? Can we expect that in China as well?
I definitely think there are going to be lots of frictions as things open up again. Inflation has been actually quite low in China in contrast to a lot of the world where there's been opening up. And so I think there can be some frictions as people go back to spending and as they try to sort of increase the amount of services production that goes on there. So whether or not we've learned the lesson is in some sense off to the side. The fact remains, it's just really hard to open up an economy after a pandemic.
Seth, let's go back to the U.S. Is U.S. consumer spending just headed into a dark place? Are you talking about a job market slowdown, a potential recession? Inflation is still high, and that is just a couple things on a long list of, I would say, even a low savings rate facing many households.
So there are lots of different cross currents. I would say one thing, when it comes to inflation, what we already see in the data is that consumer goods inflation is coming down. We've seen several categories of consumer goods where the month-on-month change has actually been negative. Automobile prices, used auto prices actually have come down for the past 2 months in a row. And so we are starting to see disinflationary effects there when it comes to consumer goods. Housing is clearly important when it comes to rents. That's rents or owner's equivalent rent, 40% of core CPI. What we know in terms of the new contracts, new leases, is that the rate increases for rents, that's actually stopped and is starting to level off. So in that sense, I think we are starting to see the beginnings of this disinflationary trend that we expect to happen over the course of next year. But interest rates have gone up a lot. Mortgage rates have gone up a lot. The housing market has clearly turned over. And that means lots of things. It means less housing, it turns out, but also people often buy durable goods to go along with their new home purchases, whether it's a new home or a used home. And so in addition to the higher cost of financing those durable goods, there's just going to be less demand. And so we do think consumer spending will go down. It's not going to be even. Services spending is still pretty robust. We've seen continued hiring in services. So it will be mixed across different sectors. But we do think overall, as spending slows, it starts in a few places, housing, durable goods, it slowly starts to spread out across the economy. consumer spending almost surely is going to come down.
And so with that, to what extent will we see that this holiday season in the consumer spending, and that already starting to be the actual picture that is being illuminated in front of our eyes, perhaps?
It is always hard to pick one specific holiday season. There's reasons to think things could be softer. On the other hand, we still have people who had pent-up demand for spending. It's been a rough couple of years for everyone across the country, and the holiday seasons are one time where you get to, let loose a little bit. I think the bigger picture, and what's going to matter much more for the Fed, in fact, is what happens not just for the holiday season, but what does that jobs path look like over the first half of next year? What does consumer spending look like over the entirety of the first half of next year?
Absolutely. It's great to have you here with us in studio. Morgan Stanley Chief Global Economist Seth Carper joining us here on Seth. Thanks so much.
Thank you.
Absolutely. Guys, coming up, the results for the Georgia Senate runoff election. They are in. We're going to share the details next. Democrat Reverend Raphael Warnock defeating Republican challenger Herschel Walker in the Georgia runoffs. Warnock's victory securing a firm majority for Democrats in the Senate and closing out disappointing midterms for Republicans. Here with more, we've got Yahoo Finance's Rick Newman to help us break this down. Rick, what did we see ultimately play out and transpire in Georgia? And what does this mean for Georgia's future as well, perhaps as a swing state?
Yeah. Well, first of all, the election went about as polls suggested it would. So the polls actually turned out to be correct on this one. Raphael Warnock, the Democrat, won by a couple of percentage points over Herschel Walker, call it 51-49 roughly. So Georgia now has two Democratic senators. And, a few years back, I don't think anybody saw that coming. Now it still has a Republican governor. But we're seeing a realignment of what you might call the swing states in big elections. So it used to be Ohio. As Ohio went, so went the nation. Not so much anymore. Ohio has tended to become Republican, but We're seeing swing states emerge in Georgia and also Arizona, purple states. So this is all going to play out, of course, in 2024. But for now, the net result of the midterms for the Senate are that Democrats actually gained 1 seat. That was because they flipped Pennsylvania and they defended all their other seats. So the Democrats have to be happy about that because they overperformed.
And yesterday was not just a defeat for Republicans generally, it was a defeat for former President Trump specifically, who had been a big backer of Walker. And then there was a legal defeat suffered for his company as well.
Trump is having a terrible end to 2022. So in this lawsuit in New York City, where the district attorney there has been prosecuting Trump's company for tax fraud and related things, a jury found the company guilty on all of 17 counts. Now that does not mean Trump, that they did not prosecute Donald Trump directly or any individuals. They went after the company, and the company's probably going to having to pay a fine, not a big fine. So more like reputational damage. But look, the tide is turning big time for Trump here. There are other legal cases against him that are getting considerably more serious. There's the federal case with the Justice Department and the classified documents Trump took after he left office. There's the election fraud case in Georgia, and then there is just Trump's political ability. He's turning into the kiss of death for Republican candidates, and the pattern we clearly saw now that the midterms are over is that Trump can get candidates nominated in the primary elections. I mean, he still has that degree of control within the Republican Party, but these are by and large candidates that cannot win in general elections. So Trump is becoming a multiple loser. I mean, he obviously had an upset win in 2016, but he cost Republicans control of Congress in 2018. He lost in 2020. He directly lost the Senate because of the 2 runoffs in Georgia for Republicans in 2020. And now he has contributed to a major underperformance by Republicans in 2022. So I'm sure Democrats are hoping that Trump's influence continues to dominate within the Republican Party because maybe he'll help them lose in 2024.
Yahoo Finance senior columnist Rick Newman, always bringing that fire for us. We'll talk to you soon.
Bye, guys.
Straight ahead, we have a few earnings reports to dive into, including results out of home builder Toll Brothers. We'll be right back.
Let's talk about some movers that we're watching this morning ahead of the opening bell. Carvana tops the list, and then some. It's down by 36% this morning. A Wedbush analyst cutting his recommendation on the online used car retailer to underperform from neutral and slashing the price target on the company from $9 to a street low of just $1. It's really what's in this note that is sending the shares down to such a degree, saying that there could be a bankruptcy restructuring of the company, and if that happened, that the equity would be worthless potentially. That is now there's a higher likelihood of this because there have been some negotiations with lenders here. According to Bloomberg reporting last night, the largest creditors of the company, Apollo Global and PIMCO, signed a new agreement to negotiate with the company. And so that apparently has raised some alarms here about what that signals.
And of course, you mentioned, Apollo is the parent company of Yahoo, but this is now, Carvana, I would say, the most hated stock in the entire market. This is probably looking like a real fundamental train wreck next year. Debt restructuring, continued losses, and it boils down to this. Can they raise capital next year to keep their business going? And if they do, what do the interest rates look like on a business which is clearly not operating where it was 2 years ago during the pandemic?
Well, we were just talking about it. It's a business that has become really good at trying to make sure that it's servicing its consumers by giving away money for your car, by making sure that any type of that customer experience that typically would knock on a brand elsewhere or a larger distributor or dealership, they've tried to course correct for that, and that experience has cost them too. There's also the customer acquisition costs. There's, of course, a time now where consumers are pulling back on the number of used car purchases that they're making too. And that's coming off of some of the used vehicle sales that we saw in 2021 that had actually risen by about 10% when compared with 2020, where people had more favorable terms as well for their financing.
And I just want to dig into what's going on currently with the company. So the company has about $4 billion of debt that is controlled by these entities. It's not just Apollo and PIMCO, by the way. There are other creditors that have also banded together. This agreement, according to Bloomberg, lasts 3 months, and it essentially would allow them to negotiate with each other and with the company so that you don't see sort of a splintering of obligations in the event that there is some kind of restructuring.
Which is super negative for Carvana.
Correct.
Super negative.
Exactly. And so, again, this implies that the credit is distressed. Right now, the company's bonds, its debt outstanding, trading below 50 cents on the dollar, which implies that investors believe that there is going to be a default on the debt, i.e. some kind of bankruptcy proceeding. One interesting thing that Wedbush points out is the company does have $2 billion worth of real estate that it owns, and so that would be its sort of easiest, readily available source of capital if it decides to start selling off assets.
Yeah, it's all those giant vending machines they've been opening.
They need space for those.
They need space for them, but
yeah.
Obviously the winners here will likely be an AutoNation and a CarMax too. Obviously they're the more established auto sellers in this country. So if Carvana goes away, I mean, that's a big, a lot of market share left up for grabs.
Well, and could the winners also be car shoppers, right? Because if you have all this inventory that is then going to be coming to market through different vendors, maybe they're going to be, I don't know, more to get it off their lots. Maybe
Right.
they're going to have better price. You know, we just
Fire
heard
sale prices.
Maybe. I mean, we
Yeah.
just heard Seth Carpenter talking about that already. We've started to see used car prices come down. Does this? I don't entirely understand all of the dynamics, but does it suggest? One question asked: does it suggest that we could see further pressure on used car prices?
Well, the pricing has to normalize, and for
Sure.
the normalization of used car prices, that's also going to bring, hopefully, a wave of consumers that have been sitting on the sidelines and saying, I could just get a new vehicle at this point, unless there's something that's really compelling in the used car market for me to go after aggressively right now.
And tie this one in a bow, Wedbush noting right at the top, their headline, bankruptcy risk rising. Pretty much says it all.
What's your target? What's your target vehicle that you're looking for?
Target vehicle, I would love to just get back in my 2014 CLA Mercedes.
Oh, nice.
Yeah, it's probably even cheaper now.
It might be on Carvana.
Might be on Carvana.
All right, we got the opening bell here on Wall Street. Volaris, maybe not driving up, flying up to the podium there this morning and ringing the opening bell. So we've had 2 days of declines here for the major averages that have been pretty steep. 2 back-to-back declines of more than 1% that have sent the S&P 500 to its lowest since November 9th. Now the question is, are we going to get 3 days in a row of declines amidst all of the negative commentary that we've been getting from CEOs, from strategists. We'll see if that continues to weigh on things. Right now, it seems to be continuing to weigh on the major averages here and on sentiment, Brad.
That's indeed correct. We're seeing some weight here out of the gate. Dow Jones Industrial Average is down right now by about 0.2%. Look at those past 3 days here. We're down by a little more than 2.5%, about 2.6% for the Dow 30. And then additionally, the Nasdaq Composite over the past 3 days down by 4% here. Significant sell-off that we saw yesterday, that adding on to some of the declines that we had already seen. And so we'll continue to watch that in this broader, or at least 3-day trend lower here. But then additionally, taking a look at the S&P 500, you're seeing that down right now at the opening cross by about 0.2% over the past 3 days. Again, that's down by about 3.4%. Want to take a look at some of the sector activity also that we're tracking here out of the gate on this hump day. Taking a look at the S&P 500, 11 sectors. We've got a few positive movers here on the day, but yeah, consumer discretionary, that is still down here, and that's adding to some of those multi-day losses that we've been tracking over the past 3 days, down by about 5% for consumer discretionary names. However, one of the leaders on the day, you've got healthcare. That's leading the pack right now, looking healthy with some gains up by about 0.4% right now.
Yeah, and we are going to talk healthcare and biotech specifically with Michael Yee of Jefferies in just a few minutes to get his outlook for biotech stocks next year.
Sounds like a healthy segment to me. Oh, all right. Shares of Toll Brothers are on the move following a quarterly earnings beat, but the CEO did warn about the impact from the ongoing housing market slowdown. A couple numbers that jumped out to me here, guys. Net signed contracts were down 60% in units and 56% in dollars in this most recent quarter. Longtime CEO Douglas Yearly noting that the dramatic increase in mortgage rates since March presents a challenging market as we enter next year. Well, yes, it does.
Yeah, absolutely. And a few of the calculations that I was actually running for Toll Brothers, even if the pricing is higher year over year, you're still looking at an environment for them that has started to pull back because of the net signed contract value actually down by about 21% here. Contracted homes actually down 34%. That number coming in at 8,255. And particularly, one of the calculations that I was running was just to see how much people were paying on average for a Toll Brothers home. And on that $3.6 billion figure that they had mentioned with about 3,700 homes that they sold through, $956,000 was the average selling price for a Toll Brothers home in this most recent quarter. And so you think about the environment for financing right now, that's going to continue to be a headwind. And then additionally, how much they're going to have to continue to spend just to find property, to find real estate that they can build on top of. I don't know, maybe they've reached out to a Carvana since they're sitting on some lots there.
I mean, we've had so many companies come out and say that the outlook for 2023 is uncertain. So some of the analysts said that the fact that Toll Brothers even came out with an outlook, even released an outlook for 2023 is more positive, right? And the outlook is adjusted gross margin of 27%, earnings per share of $8 to $9 in its full year 2023. So it seems like analysts were fairly positive on that outlook. You're looking quizzically.
No, what is interesting, because we see this Toll Brothers quarter not good. Lowe's out this morning, new $15 billion stock buyback plan, also saying that demand is pretty stable so far in the fourth quarter. Real, I guess, difference between homeowners doing it yourself, fixing up or sprucing up your home, and I guess the new home buyers.
Well, and on that front, by the way, we're going to talk to the Ferguson CEO a little bit later in the show, which is a maker and retailer of home-related products. So they just released their earnings a couple days ago, so that should be interesting, too, to give us a fuller picture of what's going on in the industry.
Absolutely. One of the other, and I guess somewhat saying in the home space, but more the home rental space, if you will, Airbnb. Let's talk about shares of Airbnb. They're moving lower by about 4.5%. That's following a downgrade to underweight from from Morgan Stanley. The bank also slashed its price target for vacation rental giant down to $80 from $110. They're citing slowing listing growth, occupancy headwinds, and lower room night demand as reasons for the downgrade there. And we had just seen a few of the announcements come through from Airbnb, some of them part of the winter release. But the major move that they're signaling is that going into a recession or going into an economic downturn, there are going to be more people that want to make that extra income. They're trying to tap into that market. However, the street might be seeing some counter headwinds, if you will.
Yeah, I was just hitting refresh on my Airbnb Yahoo Finance chart. Airbnb shares down 51% over the past year, despite really, they put up some good quarters.
Yeah.
Market's just not buying it.
Yeah, and by the way, this is not the only sell on this stock, which I was a little surprised by. This is the fourth underweight. Some of them are not from as well-known big Wall Street firms, but nonetheless, there are 4 of them. And it is maybe a little bit surprising given, I mean, obviously Airbnb has some different things that affect it rather than the bigger travel industry. We have seen strength in the bigger travel industry and airlines and hotels, for example. But one of the other areas that potentially is challenged is online travel booking sites, because they got a couple of downgrades this morning also. Expedia and TripAdvisor both cut to underperform over at Wolf Research, which says that the online travel sector should be avoided by investors. So it's quite interesting here, given what we've been hearing from companies about how strong travel is right now, that you're getting these kinds of calls. The analyst over at Wolf says travel demand is likely to moderate.
You know, this is one that I kind of scratch my head about, because even if they're saying that travel demand is likely to moderate amid a macroeconomic slowdown in 2023, we've heard on the other side of that the golden age of travel that we're entering into. And if there was an economic slowdown, wouldn't people be looking for the deals or doing more price comparison, which is exactly what these services lean into?
Or maybe they won't be traveling.
Maybe they won't.
I mean, people cut back on travel when there's a recession. If they don't have money, they don't go anywhere. So it is possible that we're all being a little too sanguine about leisure and revenge travel and whatever else we want to call the latest phase.
Or maybe that it's just, at this point, winding down in that golden age of travel. Maybe we've already hit peak golden age.
Who said these were boring markets? Look at all these movers we fit in here today. What are we, like 8 or 9?
Who said they're boring markets?
I mean, I don't know. It's not earnings season anymore. It's December. It's the holidays. You should be hanging out with Santa, buying gifts and stuff. But we fit like, I don't know, 9, 10 movers.
You should be watching Yahoo Finance.
Besides that.
Yeah, I was watching Wednesday for what it's worth.
Me too.
Guys, coming up, Apple is reportedly bumping the brakes on its self-driving plans until 2026. We've got the details next.
Watch it right now.
Pumping the brakes. Apple is scaling back its electric autonomous vehicle plans and delaying its target date to 2026, according to a new report from Bloomberg. Yahoo Finance's Pras Subramanian joins us now with the details on this one. Pras?
Yeah, Brad, Mark Gurman with a big, extensive report on Apple's self-driving Apple car initiatives here, postponing that car till 2026. Now hearing that it was supposed to be a robo-taxi type vehicle with no pedals, no steering wheel, but now they see this as being a problem in terms of level 5 autonomy. It's too many tech obstacles. We've seen that across the board with other companies. So now they're talking about pushing the delay back, doing it such that you can still have a steering wheel and pedals, but you can sort of watch TV, play games on the highway. That's when they'll initiate the self-driving just on the highways alone. So Apple kind of scaling that back. But Gurman reporting that the car would cost around $100,000, so kind of targeting the Model S, Mercedes EQS sort of range there.
Oh, there's no Apple car coming. It's not coming. We've been hearing about this for 5 years. It's not coming.
I know. And it's another blow to sort of self-driving. We saw Ford pull the plug on Argo AI, and also all the problems that Elon Musk is having with Tesla and their investigation with NHTSA. So it's sort of another blow for self-driving. But the Apple car it might come, but I think
let them stick to CarPlay. Yeah. I mean, let them stick to the software. Why do they need to be investing all this capital in making cars?
I mean, it sounds like they think it's a big moneymaker for them. Potentially another big product avenue they've not gone down before. They work with a company that can give them a platform to work with. They just sort of have them, like maybe a contract manufacturer, make this car. They provide all the chips and the software, which they're really good at. And maybe this is a product that can actually kind of scale up.
Maybe. I mean, at the same time, you have Uber. There's a new report that you can hail an Uber robotaxi in Las Vegas. So, there are pockets of it. I mean, when we talked to the Argo AI CEO, I don't know, in 2020 even, maybe it was, he said that it's not for every use case.
Yeah.
And so maybe taxis are the use case that does make more sense.
In certain urban environments where you're doing short travel, defined sort of grid pattern maybe. Like you said in Vegas, Uber's going to partner with, I think it's called Motional.
Yeah.
To do that. It's funny because they pulled the plug on their self-driving initiative 2 years ago. So they're kind of dipping their toe back in there in a limited way, and then eventually they say that in 2023 you'll see the cars without actual operators. Like right now there'll be operators driving with the car. So we'll see that happen, and that should be interesting to see what that's like. But I agree with you. You're not going to see the all-out full self-driving everywhere, at least not for a while.
It's also Vegas, where there's pretty much one temperature or one weather pattern all the time. So
and everyone's
consistent
partying.
in that. Yeah. Additionally here, we also know that Honda's got some news out this morning, or at least the engine failure reports are continuing to come forward. What do we know about that?
Yeah, reports that NHTSA is investigating 1.7 million cars, Honda HR-V, CR-V SUVs for a sort of rear differential that'll lock up and the car will stop at high speed on a highway. I mean, this doesn't sound good at all. There's no recall announced yet. Honda's working with NHTSA to look at the field reports, they call it, to see what's wrong and see if they can just fix these on one-off issue, or if it's like a larger recall, that would be, I would imagine, in the billions of dollars.
And it sounds like it's not just Hondas either, right? There's some Jeeps that are affected by this. There are Ram trucks that are affected by it also.
Not that particular problem, but there's part of a bigger other recalls that are happening. But this would be one of the biggest recalls of the year if this is a 1.7 million car recall.
Yeah, if you're going 60 miles an hour, I imagine you do not want your back end falling out of your truck.
Going locking up.
Definitely not. Pras Subramanian, thanks so much. All right, rising interest rates this year have led to a slowdown in the once ultra-hot U.S. housing market. And by extension, lumber prices have been sawed into sawdust. Lumber prices are at their lowest level since June 2020, down about 78% from the peak hit in May 2021. And there I am smiling on that joke I just made. Straight ahead, we'll get a few 2023 healthcare stock picks from one top analyst. We'll be right back.
Healthcare stocks, Amgen, Gilead, Biogen sitting at all-time highs to wrap up a tumultuous year for the sector. Joining us now to preview what to expect in 2023 is Jefferies Managing Director Michael Yee. Michael, it's great to see you as always. I was checking out a video outlook that you just did recently where you talked about BAMG. Is that what I think that's what you called it. What is it? Biogen. This is like your version of FANG, I think. Biogen, Amgen, Moderna, Gilead. Is that what it stands for? Talk to us. Is that where the money has been going and will continue to go?
That's close. It's close. It's the big pharmas, Bristol, Amgen, Merck, and Gilead.
Got it.
Yeah, look, it doesn't matter what acronym you use. The point of the matter is large biotech, large pharma has been a great place to be this year. Continue to believe it's going to be a great place going into 2023, particularly due to the defensive money flow rotation, which you have seen as everybody is fleeing growth going into recession. Tech stocks, growth stocks, obviously a tough place to be. So large pharma, large biotech, been a great place to be. A lot of fundamentally good things going on there. And these are great stocks to be right now and going into 2023.
Michael, one of the things that I keep focusing in on is the number of different patents that are going to roll off over these next 5 to 10 years even. And so as you think about that, this could be a heavy kind of CapEx or just spending environment for some of the biotech or biopharma companies as well. How do you evaluate that?
Yeah, well, two parts. Good to be here too, by the way, and talk about this because on the first hand, these companies have had difficult periods of patent exclusivities. It's very difficult to generate new drugs. And I might mention drug pricing reform has also been a big overhang on these stocks. The important thing for investors is that this sector has been trading at a significant discount to the S&P and to historical levels over the past few years as people have digested and priced that in. So a lot of that has been reflected in stocks. And that's why things like Gilead and Amgen have been trading at 10, 11, 12 times PE multiples. And so what we have seen is that a rejuvenation where new pipeline drugs, Alzheimer's drugs, obviously last week with Biogen, a new obesity drug with Amgen, their new pipelines and the new outlook causes these stocks to have higher multiples. So you've seen a re-rating of the multiples, and they're still not expensive, trading at 13, 14, 15 times, still kind of a market multiple. So even though there has been concerns and risk with patents, you have seen a lot of that been digested and appreciated. And now we actually see multiple expansion as the pipelines are coming through and as the space is a lot more attractive, particularly going into a tough macro economy in 2023.
Yeah, and what makes it particularly attractive besides some of the factors you've been talking about? I mean, there is that defensive seeking money that has been flowing into it. Are there other sort of catalysts as well that we're going to see going into next year?
Well, I think as people digest what has happened, which has been drug pricing reform, tough patent situations, and certainly a money flow excitement over growth stocks over the last couple of years, I think you're going to see 2023 as a rotation, particularly because we shouldn't forget that these companies have been spending hundreds of billions of dollars on new drug development, and these drugs can work. They are producing life-saving drugs, and we're coming back to fundamentals. And so I would just start with, look, let us remind you that a COVID vaccine, which saved the world, obviously was an important development for biotech in the last year or two. And trailing right behind that, a new Alzheimer's drug with Biogen, with exciting data over the last year. And that drug is going to get approved in Alzheimer's next year. And Amgen with a new obesity drug, which is going to be a game changer. So, look, I just think that we have been forgotten over the last few years. And I think people are coming back to fundamentals. The stocks are cheap. The stocks are underappreciated and underowned. And I certainly think that can result in stock appreciation over the next year or so.
Michael, are there any acquisition targets you're looking at?
Yeah, thanks for bringing that up too, because I do think that M&A is also another important theme. In part with large cap, I know that Amgen looking at Horizon is on the tape, and we had a note out about that. That set Horizon up, but certainly for small and mid cap biotech as well. And so we think with pharma, with more cash in their balance sheets than in history, and with small and mid cap biotech trading at a discount, we certainly think M&A can also be another positive tailwind going into the year. So a lot of things moving here, a lot of positive tailwinds. We certainly are more constructive on the space going into 2023.
Michael, 30 seconds left. Your top 3 picks.
Yeah, we like the Amgen, we like the Biogen, and we like the Prothena, ticker PRTA as well.
All right. In less than 30 seconds, you get the gold star. Michael Yee, it is always a pleasure to catch up with you. Michael Yee of Jefferies. Appreciate it. Coming up, our company of the year, Costco, set to report earnings tomorrow after the bell. Saz has got a take for you next. Retail giant Costco, also known as Yahoo Finance's Company of the Year. It's reporting earnings tomorrow after the close, and Saz has got his hot take on what to expect.
Yeah, I'm really beating into the ground this Yahoo Finance Company of the Year, as we should, because it's Costco and it's very exciting. So the company is reporting earnings after the close tomorrow. A couple things I am watching ahead of these results, and there's my trusty list. First, sales trends in more expensive discretionary products. Costco, I think, has acknowledged that they have seen a little bit of a slowdown. Those
giant teddy bears?
Not giant
big
teddy bears.
Wine?
No. TVs and jewelry. Those big 93-inch plush bears are in fact still selling, Julie. Next up, profit margins with inflation coming off its peak. Gross profit margins, I should say more specifically. Watch to see how those pan out with inflation coming down a little bit, notably in food. And then hints at a membership fee increase. You better believe that CFO Richard Galante is going to be fielding at least 2 or 3 analyst questions on this earnings call about a membership fee increase at some point next year. They have held the line, even as Sam's Club has raised membership fees. But if Costco does raise fees, it could be a big boost next year. Now, speaking of Galante, I caught up with him in a new store opening as part of our Company of the Year coverage. Take a listen to what he said ahead of these earnings reports.
Look, my answer is it rains on everyone. Maybe it drizzles on us, not hard rain. And so we've done a little better than our peers. This was a slight downtick in those numbers. And as one of the analysts said, in some ways we're priced to perfection. We sell at a very attractive multiple. We're doing well.
And Galante explaining the market reaction to November sales that were reported on November 30th. And the market really hammered Costco shares because same-store sales slowed month over month. It was a good month, relatively speaking, versus retail. But as Galante noted correctly, Costco stock is priced for absolute perfection, meaning sales theoretically should have accelerated and they didn't. Now, Costco shares so far month to date are down about 11%, in large part because of that miss. Citi noting this morning in a note that Costco remains one of their most crowded retail trades, so it'll be interesting to see that market reaction to that report. My take overall is this, and really, no matter the quarter, no matter how it shakes out, Costco is in fact very deserving of our Company of the Year award in my humble view. There I am holding that legendary hot dog, which Costco held the line on that price for $1.50, and the unlimited refill soda that goes along with that hot dog. This company has been operating at a very high level during a very challenging year for most part of the year, so double-digit same-store sales increases.
Yeah, going to be a big quarter to track for them. Of course, we already get some of those numbers out on a more regular cadence, fortunately, but I think for how they're engaging with the consumer right now, and consumer that's looking for better optional pricing at a per unit basis too.
Darn good hot dog.
And what about
Is it beef or pork?
Well, I didn't include that in my piece, Julie.
We don't know? We don't know the answer to this?
Maybe it's a mix. Is it a mix?
No. It's either beef or it's pork.
All I know, it's a giant hot dog. It's $1.50. It tastes good, and it came with a refillable soda.
I'm just saying there's certain segments. Well, I guess if you're vegetarian, not eating in the first place.
It melted in my mouth. It was great. It had little sesame seeds on the bun. It was great.
I don't know that I want a hot dog to melt in
It was just
my
an
mouth.
amazing.
That's
a space hot dog.
describer that I would use for
Listen, I mean, there's only so
hot
much you can report on.
dog.
This was our
You
Company
want
of
it
the
to
Year.
be
The hot dog is
toothsome.
good. It was so good. Had a nice little crisp, just melted. It was just great.
The hot dog debate rolls on the other side of this short break. Coming up, Twitter turmoil escalates as Musk lets go of the social media company's legal executive. We're going to share the details next.
I think it's pork. Welcome back to Yahoo Finance. I'm Brian Sozzi here with Julie Hyman and Brad Smith. We're still seeing some pressure in markets after Tuesday's sloppy close. Right now, we're seeing all three major indices in the red. I will also note this too, for those of you watching live on Yahoo Finance on YouTube, we were talking about Costco's hot dog in the last segment. I can confirm it is all beef. I incorrectly reported it was in fact pork. All right, here's what's on tap this hour. Inside, how's the housing market slowdown? The CEO of building product supplier Kevin Murphy joins us in studio for a dive into the state of his business ahead of 2023. And shopping for holiday bling, we'll check in with Signet CEO Gina Drosos in the wake of the jeweler's better-than-expected quarter and upbeat take on the holiday shopping season. And talking to the chair, we'll have an exclusive interview with SEC Chair Gary Gensler as calls for major crypto regulation rain down following the downfall of FTX. Brad, over to you. Big hot dog fan.
Big hot dog fan, big burger fan as well. Actually, even bigger burger fan, I will say. Cheeseburgers, particularly bison burgers, even better. Anyway, Dow Jones Industrial Average, you're seeing that down right now by about 0.1% here. We did touch positive territory across the major averages momentarily early in today's trading activity. I'll take a look at some of the candlestick movement that we have tracked there for you. But ultimately, right now, we are still down by about 0.1%. The Nasdaq Composite, you've now seen that move just a little bit lower than where we were earlier. That did touch positive territory as well right now, but we're down by about 0.7%. And then the S&P 500, we're also still seeing that lower by about 0.2% here. I want to take a look at some of the other activity that we're tracking here on the day. I'll come back to this social board in just a hot second here, but taking another quick gander at some of the sector activity that we've seen move around quite a bit here. We've still got energy right now that's moved into the biggest gainer on the day. That's up by about 0.7%. However, now bringing up caboose, you've got technology. That's down by about 0.9%. And speaking of technology, let's take a look at some of those social media stocks to see how they're doing on the day. Just to put this in an equal view for you, you've got Snap and Meta down, both of those by about 0.5%. However, take a look at some of the other big movers there. Google or Alphabet, you've got that down by about 1.2%. And staying with the theme of some social media, or at least a person who owns social media and the company, Elon Musk facing a new bump in the road in his Twitter takeover journey. Musk informing in a tweet yesterday that Twitter Deputy General Counsel James Baker was exited from the company over concerns about Baker's possible role in suppression of information. And here with all the details on this is Yahoo Finance's Alexis Keenan. Alexis, what do we know so far?
Hi, Brad. So Jim Baker was one of the company's top lawyers for Twitter. He joined in 2020. He was also a former general counsel for the FBI, and he was let go after some of his internal communications from Twitter were turned over to two Substack journalists that Musk has really commissioned, if you will, to review some of the company's internal documents from prior to his takeover. Musk calls this Project M, calls it the Twitter files, rather, and he is trying, he says, to expose past management decisions that benefited or benefit Democrats and to rebuild trust on Twitter's platform. Now, he didn't elaborate, Musk did not elaborate in that tweet that you showed, but he did say that Baker was let go due to his possible role in suppression of information important to the public dialogue. Now, these two former journalists I shouldn't call them former journalists. One is a former Rolling Stone reporter. His name is Matt Taibbi, and the other is former New York Times op-ed editor Barry Weiss. Now, when they released the first batch of these internal communications, that was on Friday, and that included some communications from 2020 between Twitter's employees, some of them being Baker. And there were discussions in those internal communications about Twitter's decision to block that controversial New York Post story that ran on Hunter Biden's laptop in the run-up to the presidential election. Now, Taibbi also said that there should be some additional communications that the public can expect to be released in the coming days. That there will be more internal communications to see that these two journalists are still going through the documents. However, it's really important to note that he also said that he had to agree to certain conditions in order to publicize these Twitter communications. We don't know at this point what those conditions are. Hopefully we will find out what they are, but unusual for a journalist to agree to conditions behind their reporting. So we'll have to see what all that entails.
Well, I mean, Taibbi's not a typical journalist, right? I mean, he's probably best known for deeming Goldman Sachs, the vampire squid, right, wrapped around the face of humanity, famously in Rolling Stone, and has been an independent journalist now for quite some time. Barry Weiss, who used to be with the New York Times and then left because some controversy there, or she was seen perhaps by some as too right-leaning for that publication. I don't remember the exact circumstances, but whatever the case, that's sort of the context for this coming out. And one could argue the discussions that were revealed were sort of typical moderation discussions that happen at social networks. One more just sort of thing to throw into this, Alexis. Jack Dorsey, of course, former CEO of Twitter, tweeting this morning as well about this whole situation, tweeting in response to Elon Musk, saying if the goal is transparency to build trust, why not just release everything without filter and let people judge for themselves, including all discussions around current and future actions. Make everything public now, Dorsey says, which Musk has not quite yet done.
Yeah, though he has said that there could be a document dump that does include just unedited, unfiltered communications from the company. So we'll see if that happens.
Yes, we will.
Yes, we will. Alexis Kane, thanks so much. All right, with the broader market getting rockier, it has been a tough start to December for top meme stocks, Bed Bath & Beyond, GameStop, BlackBerry, and AMC. These four names have lost an average of 6.5% on the month, compared to a 3.3% drop for the S&P 500. The worst performing from this group is GameStop, with a 10.3% decline on news. The struggling retailer has begun laying off workers. Coming up, shine bright like a diamond. We'll speak to the CEO of Signet Jewelers on the back of that company's earnings. That's next.
Let's get down to business now with some other headlines that we are watching. Activist investor group Bluebell Capital is calling for BlackRock CEO Larry Fink to step down over the company's alleged hypocrisy around its environmental, social, and governance, or ESG, messaging. The fund says BlackRock endorses a number of bad practices and has failed on its 2020 promise to move investments beyond fossil fuels. noting that it is still a majority shareholder in Glencore and coal-intensive miners Exxaro, Peabody, and Whitehaven. In a statement, BlackRock said Bluebell has waged a number of campaigns to promote its climate and governance agenda, but its investment stewardship did not support its campaigns and does not consider them to be in the best economic interests of its clients. Bluebell, by the way, holds a 1% stake in BlackRock. And remember, BlackRock is also getting it from the other side as well. Florida pledging to pull some of its funds from the company for very different reasons. Meantime, Juul Labs reached a sweeping settlement yesterday covering over 5,000 lawsuits representing about 10,000 individual plaintiffs. That wraps up most of the legal uncertainty over the sale and marketing of e-cigarettes blamed for the teenage vaping crisis. The terms of the deals were not disclosed. Juul did say it secured an equity investment to cover the cost of the settlement. It had previously been in talks with early investors to fund a bailout that would cover legal liabilities. Juul's CEO said the settlements represent another significant step to secure its path forward. And the United States is now falling behind on its plan to reach a deal with TikTok due to growing worries over national security concerns. That's according to a report from the Wall Street Journal. Those concerns include how TikTok might share information related to its algorithm that it uses to determine what videos it shows to users, as well as the level of trust that Washington needs to give the company. TikTok says it's looking for a timely conclusion to its deal with the U.S. so it can put those security concerns to rest. Zaz?
All right, we're still tracking shares of jeweler Signet after a stunning 20% pop on Tuesday following better than expected earnings. The company struck an upbeat tone for the holidays on its earnings call, citing strength in website visits. Joining us now is Signet Jewelers CEO Gina Drosos. Gina, good to see you in our studio for a change. Thanks for coming down. Appreciate it.
It's great to be here.
Let's start on those website visits because we are smack in the middle of the holiday shopping season. What are you seeing people browse for, and what does the demand environment feel like to you?
You know, it's really interesting. One of our strategies has been to lead digital commerce in the jewelry category. It's a category that traditionally was very brick and mortar based. People only went into a store so they could be consulted or, try on the product. Now we're actually selling a lot of jewelry online, but mostly browsing. 67% of our customers go online before they come into store.
That's interesting. And particularly for the environments that we had found being beneficial for Signet is the number of people that had to unfortunately put off some of the matrimonial celebrations or the weddings. We saw a great year, of course, here in 2022, but that's expected to tick down in 2023 as some of that demand starts to dissipate a little bit. What does that look like for your business?
You know, it's very interesting. Bridal is a great business to be in. I mean, every year there are engagements, weddings, anniversaries. The first meaningful blip in decades happened because of COVID. So fewer people got engaged. Many fewer people got married during COVID because they wanted to be able to have a celebration with friends and family. This 2022 is the year of the wedding, but we've seen engagements tick down a bit versus last year's peak, probably down a little bit next year too. What we've done is pivot more to fashion jewelry. Romantic gifting has been very big coming out of COVID. People really wanting to celebrate those they love the most.
And Gina, some of the other changes that you highlighted in the earnings and in the conference call has to do with the price points at which people are buying right now. And it sounds like the lower end is maybe waning a little bit as we're seeing consumer trends change. Can you give us a little bit more detail on where on the spectrum we're seeing the buying?
Sure. Last year was a big year for lower price jewelry. Stimulus was in the market. People really, spending on themselves, which was great to see. Self-purchase tends to be a lower price purchase than bridal or romantic gifting. So we saw, big increase last year. That's been offset this year somewhat. We're still up on a stack basis. But we've seen lower income customers be more challenged. Discretionary, price increases are impacting their discretionary spend more so than higher income customers.
Are we seeing even engagement in the higher end jewelry? Are we seeing buyers make different decisions at all? Are they bringing down what they're willing to spend at all?
No, we've seen a lot of strength at the higher end. Our average transaction value was up 8% in the quarter, up 27% versus 3 years ago. That is in part because of the pivot that we've made, recognizing that lower income customers would be more challenged. For that customer, we've added value engineered product really to give them a great value, financing alternatives, but we've also pivoted our marketing and our assortment to attract a higher end customer.
Within all the categories you sell at a K or a Jared, what is growing the fastest? Necklaces, rings, bracelets? What stands out to you?
You know, diamond tennis necklaces are really big this holiday season. Yellow gold continues to trend. Diamonds set in yellow gold for bracelets and for rings have been great, but probably one of the most interesting trends is men's jewelry. Men's is really trending. Black diamonds.
Black diamonds.
Yes.
And is it okay for me to stack my necklaces? I went over to the Jared site, and there's a promotion on the top of the site. I see a guy with I think 3 necklaces on. I only have one. I only have one, Jenna.
This is popular. So absolutely. Women have been layering necklaces for a couple of years now, but this year is the year that.
So what you're saying is
really
I'm off trend.
well.
I'm off trend.
You can do whatever you want.
But I want to. I wouldn't mind helping the margins out as Signet if I look cool. It's all good.
I also want to ask you about Blue Nile and the integration there, because I know analysts have a lot of questions about the profitability trajectory for Blue Nile. What can you tell us?
So Blue Nile is losing money at this point. It lost money in the third quarter. We anticipated that, and we more than offset that loss with an overperformance on our core business, which was nice to see. We anticipate it will lose money again in the fourth quarter, and we've said that it should be accretive to our business by the third quarter of next year.
I used to follow Blue Nile a lot. Why does it lose money? It doesn't carry inventory, right?
You know, what we're really looking at right now is the appropriate balance of their inventory and assortment so that we can really get the right, margin structure, a good, better, best structure into Blue Nile and the marketing spend.
And you still
There's a lot of efficiency.
Are the stores still useful to have?
The Blue Nile has about 23 showroom stores, so you don't really buy product in the stores. You go and a consultant helps you choose something that we then custom make for you and send it to you, or you can pick it up in the store. It's very effective.
In the event of a mild recession, as we've heard from some bank CEOs, economists, what would that signal for the jewelry industry? What do you forecast or even model to some of your own business outlook as well?
You know, jewelry's not immune to macroeconomic pressure, but I would say it's very different from most of the rest of retail. Jewelry inherently holds its value, and customers know that. So they know that if they buy a nice piece of jewelry, it will be worth at least the same, if not have appreciated a year later. So we see in tough times, even including recession, jewelry actually does much better than the rest of retail.
Signet Jewelers CEO Gina Drosos joining us here on set. Thanks so much for taking the time.
Thank you.
Absolutely. Coming up, everyone, the conversation is heating up with the CEO of HVAC company Ferguson on the other side of this break.
We're watching shares of Ferguson today after the home improvement company reported first quarter earnings that showed a 16% rise in net sales year over year and 17% growth in its U.S. business. Ferguson CEO Kevin Murphy joins us now in studio. Kevin, good to see you finally in person in our studio.
Good to see you. Good to be with you in person.
Look, we got some good news from a home improvement retailer in Lowe's this morning here saying demand is stable. Is that what you're seeing in your business too?
Yeah, demand was supportive. The quarter, we couldn't be more proud of the remarkable work of our associates, driving that over 16% revenue growth and then controlling costs and driving through operating profit expansion. But if you look at what our business is, it's just over half residential, just under half non-residential. And both were supportive. We know we're going to have some headwinds on the new res side, but we're mostly RMI.
Yeah, go further into that new residential side, because we were just discussing both home building and then what that construction process even looks like. For Ferguson, where does that start to dovetail through to your business, and where do you see those impacts most notably or earliest on?
Yeah, clearly rate and the price of housing and affordability will start to get pressured, and we'll see that play out as we go through our fiscal year. We're starting to see a little bit of it now. It's only about 18% of what we do. And there's a great deal of activity that's already in play. And you think about the starts and permit activity that happened months ago, that's starting to get built through. And we're involved in everything from the underground infrastructure, the water, the wastewater, the stormwater, all the way up through rough plumbing, finished plumbing, HVAC, appliances, and lighting. So we'll see that play out as we go through the year, but it'll be a soft spot for us as we go through our fiscal year.
And let's zoom out a little bit, because we've been hearing from a lot of CEOs over the past couple of days in particular who've been speaking publicly about the chances of a recession. Yeah. So you guys are obviously, you see what's going on in terms of economic activity out there. What do you think?
Yeah, so I'll leave the recession prediction to the economists. We know we'll see some pressure on new residential construction, because as we talked about, affordability is going to be pressured as we go through our year. But for us, when we look at the balance that's out there, there's a lot of non-residential activity that will continue to be supportive. Sure, knock on, build off commercial activity after residential. But for us, it's also some of the mega work that's going on right now. Really large projects in things like LNG, pharma, what we see with the CHIPS Act and what's happening with semiconductor production. Those are huge projects for us that have miles of piping, valves, HVAC systems, fire protection, and the like.
And do you see any delays in starting new projects or even approving new projects because of what's going on with rates as well? Because of the projects you're talking about, companies, organizations, governments are borrowing in order to do those projects.
Yeah, just a touch of delay in some spots around the country around knock-on commercial activity. But again, some of these large non-res projects, these $400+ million projects, like what we heard around the CHIPS side of the world with the CHIPS and Science Act, they're already well underway and will provide a good boon for construction.
And you're involved in those?
Absolutely.
Okay.
Absolutely. We're involved across water, wastewater, stormwater on the off-site and on-site, all the way up through the production facility.
You've been very acquisitive. Do you just wish the Federal Reserve would stop hiking rates? Because they're making your acquisitions more expensive here, Kevin.
Yeah, so we look at acquisitions over the long haul. We're in an industry that's a highly fragmented one. Over 10,000 plus competitors, local, small to medium size, independently held companies, and we consolidate that market. And quite frankly, that's the fuel for our organic growth, because this is a great organic growth.
But are there deals
story.
you just won't do because the cost of capital has gone up?
There aren't deals that we're not doing because of cost of capital. Right now, what we're seeing is deal activity going to slow because people may look at what past pricing was out there, past valuations, past multiples, and maybe have excessive expectations. But right now, the deal flow is good. We'll continue to use that as a part of our growth algorithm.
All right, let's get you out of here because I know you got a busy day on tap. Ferguson CEO Kevin Murphy, good to see you in studio. Appreciate it.
Great, good to be with you. Thank you.
All right, straight ahead, we'll have an exclusive interview with SEC Chair Gary Gensler as calls for major crypto regulation rain down following the downfall of FTX. We'll be right back.
Welcome back to Yahoo Finance Live. I'm Jennifer Schonberger. I'm joined now by the chair of the Securities and Exchange Commission, Gary Gensler, here at SEC HQ to talk about regulating cryptocurrencies in the aftermath of FTX's failure. Chair Gensler, it is wonderful to be with you here at HQ.
Great to be with you, Jennifer, and your listeners.
Thanks so much for sitting down with me. So many lawmakers are pointing fingers at the SEC over FTX's collapse. You have said numerous times, rules, security laws are in place and they apply to crypto. This is an issue of non-compliance. Why didn't the SEC enforce rules on the books? Could that have prevented FTX's collapse?
We are enforcing them. The Securities and Exchange Commission, I couldn't be prouder, and it started under my predecessor, Jay Clayton, has brought over 100 enforcement cases in this space. And what we've said to what is largely a non-compliant field, there's about 10,000 of these crypto tokens. And then there's not just dozens, but maybe hundreds of service providers, broker-dealers. They might call themselves exchanges. They might call themselves other things. You might think of them as the casinos, wherein the investing public is looking for a better future. And because most of these tokens are securities, that means that the storefronts, if you wish, or the casinos, need to come into compliance with their time-tested laws. And what that means is basically not using customer funds as many of them do. Their business model right now is offering the public, they say, they're purporting to offer them an interest return in crypto, 4, 8, 12, sometimes 15 or even 20% returns, and then possibly trading against their customers, trading ahead of their customers, lending that out. Anywhere else in finance, these conflicts are not allowed and they're separated out. So we have publicly been saying to these crypto intermediaries, they might call themselves crypto lending, they might call them crypto exchanges, these crypto intermediaries, in essence the casinos, if I might say it again, to come into compliance with the law. We brought a number of actions, crypto exchange Poloniex last year, in September of 2021, when a large exchange, Coinbase, wanted to get into the crypto lending space. We said that would not be compliant with the laws the way they were set up. We brought actions against crypto lending platforms, including BlockFi. And we will continue to be a vigorous securities regulator. But I really do suggest to these intermediaries, these storefronts, these casinos, if you wish, to come into compliance, work with the SEC to get into compliance, disaggregate these businesses.
So given that you've laid out that firms cannot use customer assets to trade with.
Our laws say this.
And,
Congress
right,
has said this. You
right.
can't use
So-
somebody's stock assets
But that's
either.
exactly what FTX was doing. So it sounds like they were in flagrant violation of SEC law.
I can't speak to any one case or any one situation, but our securities laws say that you need to properly segregate customer funds. You also shouldn't be running a broker-dealer or a hedge fund and an exchange. The New York Stock Exchange doesn't also have a hedge fund on the side and trade against their customers.
Right. So to your point, you know, FTX was reportedly using more than half of customer assets to fund risky bets at Alameda Research. As you said, broker-dealers are explicitly banned from trading with customer assets. You suggested to me back in July that perhaps that this would apply, traditional broker rules would apply to crypto firms, but
they
should be tailored to crypto as well. So can we expect rules that are specifically tailored to crypto on this and other areas next year?
Look, this is a field that has caught the worldwide public attention around the globe. I would remind the public, if I could, this is a highly speculative asset class. These 10,000 projects, many will fail because entrepreneurs in all sorts of walks of business fail. Many will fail also because history tells us that we don't need and don't use microcurrencies. We have the dollar, we have the yen, we have the euro, we have the sterling, the pound. There's a reason for that economically. But if the investing public wants to invest in these tokens, they need the appropriate disclosure, just like they get the disclosure from the companies you might invest in the public markets. And the broker-dealers and the exchanges and the hedge funds, same thing. There's nothing incompatible about our securities laws and crypto. It's really just that there's a sort of a worldwide market. Much of this is offshore. I can't speak to any one matter, but I can quote from the bankruptcy court that just 2% of the customer assets at FTX were US. So it just gives you a sense of how much of this is a worldwide market as well.
Right, but can we expect tailored rules for crypto in 2023? What are your goals for regulating crypto next year?
I've got one goal, is that these platforms, the exchanges, the lending platforms, come into compliance. They can do that appropriately, working with the SEC, or we can continue on the course with more enforcement actions, and I would have to say that the runway is getting shorter.
The runway is getting shorter. You've repeatedly called on these exchanges to come in and register, and you said you're talking
and
to...
not just register, come into compliance.
Right.
Separate out their businesses appropriately, protect the public.
But to your point, we've heard from Coinbase, the largest U.S. exchange, that they're in dialogue with you, but they say it's rhetoric now. They don't see a path forward. So given what you were saying, given what they're saying, what's the roadblock? What's the holdup here? Why is this taking so long?
It really is on these entrepreneurs and business leaders in the crypto space. And it's an area that has grown up worldwide with a lot of intermingling of customer funds on their platforms, providing interest returns to their customers, and then trading against their customers and the like. The basic protections in our securities laws for 80 or 90 years apply to this field as well. And so it's really on them. We've been clear. We can use some exemptive authority to tailor things, as you said earlier, but it's not to drop the basic protections of separating out these businesses into a separate exchange. And again, I remind the public, we don't let the New York Stock Exchange also run a hedge fund and trade against customers. Separate out a separate broker-dealer, separate out separate custody function, and really use the time-tested rules of the road that are on the books. So it's kind of up to them, or we'll be, of course, following, as we've given good advice to each of these agencies around crypto lending. Actually, the way it's organized is often similar to a mutual fund. You're collecting up the public's funds, you're offering a return to them, so come into compliance.
According to your calendar, you met with now former CEO of FTX, Sam Bankman-Fried, on March 29th of this year. Aside from that, had you met with him any other times, and what was your impression of him when you met with him?
Again, I'm not going to speak to any one matters. I make, as my predecessors did as well, my calendar public. And we meet with market participants, and the basic message that I've had is the same public message as a private message. Come into compliance. Your field will not last long outside of public policy norms. I might be technology neutral, but I'm paid not to be public policy neutral, and it's about protecting the investing public. The message has also been that we're not going to let the public all the safeguards down in this regard. So some of these platforms have come in and said, we want to continue running a commingled platform. We want to continue doing lending, trading, hedge fund functions, an exchange function, a custody function. We've said, no, you have to separate it out. Some have come in and said, can we have a lighter touch regulation? We've said, no. We said, no, the time to protection. And I want to say one other thing. It would not be fair to all the market participants that comply today, the stock exchanges, the broker-dealers, the asset managers called mutual funds, and even the folks that are managing hedge funds today, that are complying, the market makers that are complying with their rules when they're trading and buying Apple stock or Ford Motor. Why should it be different here?
Yeah, to your point, you know, I'm wondering if we need proof of reserves, but not only just proof of reserves, but a way to vet internal controls on these crypto firms. Because we look at Sarbanes-Oxley, and then we look at what happened, as an example of the FTX situation. According to the bankruptcy filings, there was a huge failure of internal corporate controls. We know that FTX was technically audited, but that was not caught. So do we need some sort of rules in place for that
portion? They're in place. They're in place. See, here's the good news for the public. If you're, you know, I look to you. The good news is, over decades, we've put in place. Congress put them in place by law. This agency, this great agency, put it in place through regulation. Basic rules around books and records, basic rules around internal controls, basic rules around.
Should we expect more enforcement action then?
Look, I can't speak of any one matter. This is a great agency. We have 1,300 people in our enforcement division. We have 1,100 people in our examination division. That's half of the agency. We oversee $100 trillion capital markets. We bring about 700 enforcement actions a year across insider trading and microcap fraud and books and records violations, as you talked about earlier. And yes, we have a robust enforcement history in the crypto space. I think over 100 actions, a couple dozen while I've been here as chair, against crypto exchanges, against crypto lending platforms, against, of course, tokens. We had a very big win recently in a case around a crypto token called Library. Unfortunately for the investing public, the entrepreneurs in this field have chosen, and it's a choice, they have chosen to try to skirt the law, whether they're setting up overseas and they're servicing overseas actors. That's for other jurisdictions, that's for other regulators around the globe. But if they're tapping into US markets, they need to come into compliance.
To your point, so much of this is happening overseas. We saw that with FTX. The international unit went down, brought the US unit down with it. Do you need better coordination with global authorities? How does that factor into your ability to police?
We have good coordination around the globe, but there are different laws, and particularly in small island jurisdictions in the Caribbean island, Cayman Islands, the Virgin Islands, Bahama, Bermuda, but sometimes outside of the Caribbean. You see some of these crypto entities are set up in the Seychelles or in Malta and the like. So we have our best coordination with the larger economy countries. But that coordination is important. But I would say if you're tapping into US investors, our securities laws are to be complied with.
Okay, so then bottom line here, securities laws in place. We don't need extra tailored rules for crypto. We won't be expecting that next year.
The agency could use more resources from Congress. We could definitely do that. You raise the extraterritoriality reach. We have a reach that's US jurisdiction. But the laws are there, the rules are there, and I would say something else. The law firms know how to advise their clients to comply, they're all too often, these firms are saying, we'll set up overseas. But there was even an announcement this week by a crypto lending firm that said we will no longer be offering any of our products to U.S. investors. That's a way to protect U.S. investors as well.
To your point, Senator Elizabeth Warren wrote an op-ed in the Wall Street Journal recently calling on the SEC to quote unquote suit up. She wants you to
We're already suited up. We're already suited up.
She wants you to crack down on crypto using your existing authority. My question is, do you feel
Have you ever met Gubir Grewal, who runs our Division of Enforcement? We're suited up.
Okay, here's my question though, Chair. Do you feel you have enough authority, or do you feel that you need legislation for more authority from Congress?
I feel that we have enough authority. I really do in this space. Could we use greater resources, appropriations? Absolutely. Could we use maybe a little more extraterritorial reach overseas? Yes. But I also think it's important not to do any harm. We have $100 trillion capital markets. It's not a small number. Even our stock markets, approximately 35 or 40 trillion of that, but the whole treasury market, all the pieces of our market, we can't undermine that. As much attention as your viewers have on this crypto market, worldwide, it's about 800-ish billion. Mm-hmm. We don't know the exact number in the US, but far smaller than that 800 billion. We can't undermine all that helps drive this economy, that helps protect investors, to allow folks to raise money in the public, ultimately. We can't undermine any of that.
To your point, Chair Gensler, a new commission meeting was announced for next Wednesday on making changes to equity market structure. What can we expect next Wednesday?
Well, we're going to take up 4 recommendations from the staff around the equity market. This is a really important piece of our capital markets, and it's important to investors, and the retail public certainly has paid a lot of attention to this market. There's a growth in the market. It's about driving greater competition, transparency, and efficiency in the marketplace. And we have a marketplace today that, depending upon the day, between a third and a half is not in what's called the lit markets, but is in the dark venues, dark pools, or just being purchased by wholesalers. So it's trying to consider recommendations to better level the playing field between these venues, the dark markets and the lit markets, get more competition, particularly in the retail orders, the retail marketable orders. We'll be considering how to ensure that your broker-dealers, the public's broker-dealers, truly gives you and gets best execution when you send in those orders, and more transparency in the space. We have last updated our equity market rules in 2005. There was a lot of good work under my predecessor around data and what's called the infrastructure rule, but in terms of looking at the whole market. And so think about your iPhone from 17 years ago. You didn't have an iPhone 17 years ago, right? We didn't have, a lot's changed in 17 years.
Chair Gensler, I want to thank you so much for all of your insight. We are watching this space very closely and hope to speak with you again soon as we monitor crypto.
Thank you, Jennifer.
That's Chair Gensler, Gary Gensler, Chairman of the Securities and Exchange Commission, and we'll be right back.
Brad Smith is calling this a waffle Wednesday for the markets, and that's because we have stocks kind of bouncing around between up and down in a pretty narrow range here. That's what's going on the top line. But I'm also keeping an eye on what's going on in the trending ticker page, because there we have some more decisive moves, both the up and downside. Carvana continues to trend lower, off by 36% right now on concerns over its ability to continue in business as its debt trades below 50 cents on the dollar, and it got a big downgrade. MongoDB, software company, up 19% after reporting earnings that beat estimates. And Campbell Soup down here as well on the trending ticker page, up 4.5% after that company also reported earnings. Coming up next, Dave & Buster's shares. We are seeing them on the move on the back of that company's third quarter earnings. We'll tell you what they're doing and why. Oh, they're down 4%. That's next.
You hear the music, you know what time it is. It is time for Cover Time. 3 stories, 1 minute each. We start with this today. Microsoft announced a pledge to bring Call of Duty to Nintendo consoles for 10 years as it pushes to complete its acquisition of Activision Blizzard. This comes after the tech giant also offered a 10-year deal to Sony for the franchise to also be available on PlayStation devices as well.
Can Microsoft just bring better graphics to Nintendo systems? Whatever they're doing on the Xbox, just bring them to Nintendo. Please help them out. Just, that Nintendo's just not where it needs to be, guys.
No, I don't know.
I
don't know anything about the game.
It never has been. It never has been.
This is just the crux of the deal actually being able to go through, and for Microsoft to be able to show that its activation of, or its activation and acquisition of Activision Blizzard would not result in any type of competitive environment that regulators who are looking to move this deal forward or reviewing this deal, that they wouldn't look at this deal and essentially say, okay, this lessens the competitive environment.
Can't even look at that. You see
that?
That
video is making me. I know. We don't need vertigo from the VO. Wow. Yeah, we'll see if this actually convinces regulators to
that looks like
get them to approve
one game that I definitely won't be beating anytime soon. All right, Dave & Buster's, speaking of games, we're watching that stock this morning after the company posted a revenue beat in the third quarter, but posted slowing quarter-to-date trends that analysts are citing as a potential overhang for the stock. Pretty good quarter for this company, but again, it looks like the quarter started on a slow note for Dave & Buster's.
Well, yeah, comparable to 2021, but then you look back to 2019 and some of the year over 3 at this point now. Comps are actually pretty strong, at least on the foot traffic front, beginning of this current quarter. And so we'll see where that locks in. But again, investors are really going to have to look at this environment for Dave & Buster's and see where they're able to get people back into that experience.
Well, what is interesting, they said on the conference call, it looks like they're no longer focusing on kids. There is now a brand pivot underway at Dave & Buster's to focus on 21 to 39-year-olds. A big pivot for this company. They're going to put a lot more marketing behind that going into next year.
I guess we're not going to Dave & Buster's anymore.
No more kids. We don't want that kids business. We want you to come here.
I'm saying you and I are.
That's not very. That's not nice. That's just not. No. I'm going there. I don't care what that age group. Oh, that is awful.
There's no. Sorry, Seth. There's no teardrops on Taylor Swift's guitar after the singer was reportedly in the late stages of negotiating a $100 million sponsorship deal with the now bankrupt crypto firm FTX before the deal fell through. That's according to a new report from the Financial Times.
Well, I'm not even allowed to listen to Taylor Swift anymore. By 21 to 39, I don't fit in there now.
There's no shame in being.
But I want to go to Dave & Buster's, and I want to listen to Taylor Swift.
They play it over the loudspeakers.
Sure, do it.
Yeah, it's so depressing.
Do it. It's all right.
It just really ruined my whole mood for the day.
No.
It really just did, and I needed to say that live.
Well,
sad.
I'm very sorry.
We can play you some Taylor Swift, and that'll surely.
If I want to get more sad, I'm going to go
I'm sure that's really going to cheer you
I'm going to
up.
pull up Carvana stock and get even sadder now.
Thanks.
Anyway, T-Swift avoiding, I guess, dodging a bullet by not partnering with FTX like many of her peers on the A-list did. But, I mean, I don't know. It's sort of a moot point now, isn't it?
Right. She's probably glad that she wasn't able to, or did not, to go forward with it.
Not going to be named
Brad,
in the
enjoy your
lawsuit.
trip to Dave & Buster's. We'll send us some photos because me and Julie aren't allowed in there anymore.
They got great games at Dave & Buster's.
All right, cool. Great.
Yeah. I'll live stream it for you.
Coming up, Akiko Fujita and Rochelle Hakufa will discuss the latest amid China's reopening struggles with an analyst from Eurasia Group. You don't want to miss that. I'm going to now try to cheer up Saz. That's my quest for the day.
Need a bagel.
I'll live stream it on Twitch for you.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast and 8 a.m. on the West. I'm Rochelle Akufa with Akiko Fujita, and here's a look at what we're watching today. Recession trumps reopening. China unravels zero COVID, but also offers trade data that puts slowdown fears center stage. How's the rest of the world impacted? Well, Eurasia's Neil Thomas gives us his take. And small margin, big win. Getting things done in the Senate should become an easier lift for Democrats. That's after Raphael Warnock's victory in Georgia. We'll speak with a DC strategist that knows a thing or two about the balance of power. And not always a labor of love. Job cuts are painful for anyone, but there are particular problems for the tech sector, with so many workers in the US on immigrant visas. We'll ask a leading immigration attorney what she thinks are the best options. But first, let's get you a check on how the markets are doing at the moment. As you can see, a mixed picture here. The Dow, they're up about 140 points. The S&P 500, they're up about 11 points, relatively flat. And also the tech-heavy Nasdaq, just slightly in the red there, trying to perhaps eke into the positive territory, but not quite making it yet. Also taking a look at treasuries, we see all three of those, the 5, the 10, and the 30, under pressure today, all in negative territory. All right, well, China advances towards dismantling zero COVID controls, pulling back many of its quarantine and testing requirements following nationwide protests. And as the country shifts towards recovery, senior Chinese officials are reportedly considering an economic growth target of around 5% for next year. Now, this is a very interesting, an interesting point here, because we know that China does rely on these growth targets. They do everything they can to get there. A lot of people wondering, though, how realistic this is, given how much it's still going to take with this very gradual reopening right now.
Yeah, Rochelle, this really gets to the heart of the question that I have in what is playing out over in China, which is the timing of all of this. Why now in terms of easing those COVID controls? Because when you think about it, they have seen the biggest surge in case counts since the start of the pandemic, when we saw that initial surge out of Wuhan. The Chinese government over the last 3 years has spent those years defending its zero COVID policy, saying that it was essentially an all-out people's war. And then today we heard the state council say essentially that this was a response to strong reaction from the public, which, Rochelle, we should point out, come as close to an admission as you'll get, I would argue, from the Chinese government that, yes, we are responding to the protests that we've seen over the last few weeks. Now, there's another story that we are watching, which is what you pointed out. It is the economic picture. We started out this year with a 5.5% target from the Chinese government. Well, that's since been pulled back significantly, some saying 3%, some saying sub 3%. And you have to wonder, now that we're getting these reports that senior Chinese officials are considering a 5% growth target for next year, are we at that tipping point where the economic pain is simply too much for this COVID policy to continue? Now, worth noting, when you look at the market reaction today, not as significant as you would have seen in the past when China has, or if there were any hints of China shifting its policy. But I would argue part of that is because the Chinese government's in a bit of a dilemma. I mean, you could pull back on the COVID restrictions, and yet that risks seeing those case counts go up when China has relatively kept its case counts low. And yet, if you keep the policy in place, we're talking a further pulling back of the economy. So it really is kind of China being painted in a corner. It's going to be interesting to see which way things go at a time when we're seeing a global economic pullback.
And you raise a good point, because I think investors have seen the rug sort of get pulled out from under them when China started reopening, then cases went up and there was a reversal. It does seem, though, this at the national level is at least a first move for China in really having this coordinated effort to undo its zero COVID policies. But I think investors don't want to get burned. And I think they obviously have other things to focus on. They're still looking at the Fed. They're still looking at what's happening with inflation data. So I think because their interests are spread quite a lot right now with that focus next week on what we might hear from the Fed, I think perhaps investors not quite as excited as they would be. I think a lot of caution here. And we did see that Morgan Stanley did upgrade China stocks from equal weight that it's held since January of 2021, now holding it to overweight. They're bullish, but they're cautious, I think is the theme right now. Because as you can see there, the number of lockdowns that we're seeing in some of these big Chinese cities, they don't have the capacity at the moment that we saw at the beginning of the pandemic with these pop-up hospitals to perhaps manage what they might see in intensive care units. So some cautiousness here for sure.
Yeah, I mean, you're certainly right to point out that there's a lot weighing on the markets right now. I mean, it's not just the China story anymore. It is, of course, the Fed with the FOMC meeting coming up next week. It's the global rate hiking environment if you look at central banks around the world. But also, if you look specifically at China, I mean, if you think about where these case counts are going, there are concerns about vaccine hesitancy, whether in fact they can get those vaccine rates up, especially among the elderly, and then whether in fact the vaccines they have been pushing domestically are really enough. You could argue the science doesn't necessarily point to that. Are they in development of a domestic mRNA vaccine? I mean, there's certainly a lot of questions here. And again, I mean, China may say, look, we hear you protesters, we're going to pull back, we're going to start to ease these restrictions. That doesn't necessarily mean that COVID's going to go away as a result. So it is an interesting balance that, I think a lot of investors, American companies, especially that are affected by it, are looking or watching as well.
And I mean, when you think about all the disrupted supply chains that came from China not reopening as fast, obviously we're seeing some operations that Apple is considering moving to India. And a lot of these countries that have exposure there, you think of Tesla, a lot of them have a lot of questions about what happens to these supply chains while we wait for China to reopen, because the demand is still there for electric cars and for iPhones. But what can you do if the factories are under lockdown and you just can't get the production done at the end in China?
Yeah, and how quickly will things get rolling again as a result of some of these easing? So a lot of factors to be watching now. Investors specifically watching the impact China's easing will have on American companies. We're turning to Yahoo Finance's Jared Blickery here with some potential winners in the U.S. for China reopening. Jared, you could argue a little too soon to say a full-on reopening, but are we seeing a bump coming out of the news in China?
I think we've been seeing that bump come with the fits and starts that we've seen in the news itself for some time. This is what's happening today in our China-exposed stocks. By no means is this comprehensive, just meant to show a smattering. A lot of these are concentrated in the tech and semiconductor area, as you might expect. But we can see over the trailing month, NVIDIA up 12%, Las Vegas Sands up 14%, Microchip up 15%, kind of gives you an idea. And this is at the same time that Chinese authorities were also bumping and relaxing some of the onerous, I would say, monetary impediments over there. So here are U.S. companies suffering from China lockdowns, and this explains things in terms of the prior quarter, and this would be the reporting quarter and the current quarter. For most of these companies, that's going to be the fourth quarter. For Nike, it actually ends on November 30th, so a little bit in the past there. By no means is this meant to be apples to apples, but it just kind of shows you the depth of some of these companies and their exposure to China. So, for instance, in Apple in the prior quarter, the revenue was up in a year compared to the year prior. But in the current quarter, which is their biggest one, the holiday one, it was over $25 billion last year. It's expected to be 9.3% less. Nike, which experienced a 13% drop in greater China sales growth, that is expected to be up about 5.8%. In that quarter ended 11/30. For Starbucks, you can see expecting a drop in 12% in those same store sales. GM expecting total vehicles sold to drop by 12% in the fourth quarter. And Wynn Resorts, hotel occupancy already crashed 38% in the prior quarter, and in the current quarter is expected to drop an additional 25%. So even with a full reopening, going to take some time for that to work through the system, as we saw here in the U.S. So important milestone, but a lot of work to be done, guys.
Indeed, a lot of companies really relying on that reopening to happen. Jared Blickery, thanks so much. All right, well, joining us now for more on the China conversation is Neil Thomas, Eurasia Group China and Northeast Asia Senior Analyst. Welcome to the show. So, Neil, what do you make of this reopening and really the reaction from markets, as they really don't seem to be that on board that this is going to be a full reopening anytime soon?
Thanks for having me. Yeah, so this recent measures that were published by the State Council is a really significant indication that China has moved away from a zero COVID strategy, but it still hasn't moved away from a COVID control policy. I think that might be informing some of the hesitancy here in markets, because this loosening is going to lead to more undetected spread of COVID through the Chinese population at a time when the elderly vaccination rate is still far below the 90+% that Beijing has been targeting. They're trying to make progress on that and reducing the danger to the most vulnerable parts of the population. But this loosening is going to create unpredictability in how COVID spreads. So there's certainly still policy tools available and still policy scope that is left to take some steps back towards further lockdowns and in a targeted manner. We're not going to go back to trying to have zero cases across the country, but if we see some areas of the country under particular strain or experiencing a surge in cases and deaths that's overwhelming public health facilities, then we could certainly see a bit of backtracking in those localities or in certain kind of provinces and areas where that strain is particularly noticeable on the public health and kind of people's safety criteria. But a significant step for sure for the zero COVID policy overall.
Neil, there was always some expectation of an easing of the zero COVID policy, but you could certainly argue that it's been surprising to see how rapidly they've moved on this. Is this really just about the protests, or is there the economic component to it? I mean, what does that tell you in terms of the pace of these changes? What does that tell you about how she is looking at all of this?
I think it's both. I mean, we saw in early November, there were the 20 measures that were the first kind of significant easing of COVID containment controls. And that, I think, was motivated mostly by the economic picture. She had consolidated power at the top of the Communist Party after the 20th Party Congress in mid to late October. And so there was more political space for him to, address the economic side of things while still maintaining the, zero COVID policy. And I think then we had the protests in, late November, just recently. And that, I think, has fed into a sense that the party's best course of action, and the best course of action for Xi is to, accelerate somewhat this reopening. And this is, part of the Communist Party's playbook for responding to public dissent. It's a bit more sophisticated than it's sometimes understood to be. Yes, there was repression, but there's also often a tactical readjustment of policies to try and address these sources of public grievance. I think that's certainly part of what's happening now with this further relaxation of the zero COVID policy with these new 10 measures just today, China time.
Now, in the past, when we've seen some grievances in China, we really haven't seen the government, in a sense, acquiesce to this. So I do want to ask more about the economic angle, because we did see that China's debt ratio hit a record high. How much pressure is President Xi under right now to really get the economy on track?
I think Xi Jinping has always had a sense of there being a bottom line for growth. He was happy, and he said this explicitly, to make some short-term economic sacrifices to continue with the zero COVID policy. But even to achieve his more political, more nationalist goals for China as a country, that requires a baseline level of economic growth. So I think this is, part of that readjustment for him. There is pressure, not just from the Chinese people, but also, I think, internally from himself and his own goals to ensure that China is still able to grow at a positive rate and to be able to sustain at least, low-digit positive growth for the next couple of decades to try and reach, his goal to make China the world's most powerful country by the middle of the century. So I think some of it is responding to protests, perhaps in the timeline being brought forward. But I think it was always in the cards that Xi wanted to exit zero COVID policy at some point, and he's going to do it gradually, maybe less gradually than expected. But I think we shouldn't kind of overread the danger for Xi politically. He's still very much in control. This is certainly a proactive measure to try and reduce the political threat of the protests and of any potential economic crises.
Neil, zero COVID, of course, one of many issues facing China right now. Xi Jinping today landing in Riyadh to meet with senior officials over in Saudi Arabia at a time when the U.S. is not only seeing tension with China, but also with Saudi Arabia. What do you make of this meeting and what appears to be more of a warming relationship between China and Saudi Arabia?
I think Xi's trip to Saudi Arabia over the next few days is symbolic of China's increasing diplomatic efforts to portray itself as a leader in the non-Western world and amongst developing countries. That's been an emerging theme of foreign policy under Xi. And it's a response in some ways to the efforts by the Trump and Biden administrations in the United States to rally the West and US allies to cooperate more on policies that are targeted at China and trying to limit the potential for China's military development and even for its technological development too. We just saw with export controls that Biden introduced just a couple of months ago on semiconductors. So we see China pivoting to really investing in its ties with the developing world and in trying to be the kind of leader in kind of swinging some of these countries away from their relations with the United States and ensuring that the coalitions that the United States is able to build against China are going to be limited just to its closest allies and are not going to be able to extend to some of these emerging markets like we see in the Middle East and across Africa and Latin America and Southeast Asia.
And Neil, I just want to quickly touch on oil, because when you have the largest exporter of oil in Saudi Arabia meeting with the largest importer of oil in China, what about demand for some of these commodities as these two do forge a closer relationship?
Yeah, I think we're going to see, China try and reduce its dependencies on the West and on other, countries that are subject to Western sanctions, also including Russia now as well. And you're trying to make sure that it has a diversified source of energy imports. And Saudi Arabia and other Gulf countries, which are going to be meeting with Xi in Saudi Arabia, are really important players. And we've seen Xi emphasize energy security as a rising priority for the Communist Party. That was one of the clear takeaways from the 20th Party Congress report that Xi delivered in October. And it's part of a general push to ensure that economic development in China is balanced with national security considerations, of which energy security is just one of many. And so that's, growth no longer being the sole and only priority. It's still a priority, but ensuring that this national security type of considerations are addressed is, increasingly something that's considered and balanced along with growth. So I think, in terms of the oil markets, this is a potentially significant development. There is a potential for Saudi Arabia to start pricing some oil contracts in renminbi, the Chinese currency. That's that might happen, it might not, but still the fact this conversation is happening and it's a possibility. Maybe we'll see some contracts in other commodities that are introduced first in RMB, but it's just a sign of this cultivation that Beijing is doing of non-Western and emerging markets.
Yeah, certainly a lot of threads to follow through here. Neil, it's good to have you on today. Neil Thomas, Eurasia Group, China, and Northeast Asia Senior Analyst. Want to highlight one trending ticker we've been watching very closely today. Shares of Carvana seeing steep declines, hitting a new low this morning, falling below $5 a share for the first time since going public 5 years ago. Pressure on the online used car retailer mounting following a Bloomberg report that its largest creditors, including Apollo Global Management, have signed a deal binding the firms to act together in negotiations with the company that has raised speculation of a potential bankruptcy or debt restructuring for the embattled retailer. On Wednesday, we should point out Wedbush joining a growing list of analysts to downgrade the stock from neutral to underperform, and then cutting its price target from $9 to $1 a share. We should note Apollo Global Management is the parent company of Yahoo. Well, we're off for our first break, but coming up on the other side, it's not a 1% difference, it's a world of difference. Those words from Democratic leader Chuck Schumer on why firm control of the upper chamber makes life easier for his party in a number of ways. We'll discuss them all next.
The people of Georgia are better off. The Democratic Senate caucus is better off. And America is better off because he ran and won. And as I said, he's going to have a great, great future.
Well, that was Senate Majority Leader Chuck Schumer there on Raphael Warnock's victory in the Georgia runoff. The win securing a slightly firmer buffer for Democrats in the upper chamber. But what does this all mean for future policy? Well, joining us now to discuss is Pangea Policy founder Terry Haynes. Now, Terry, you don't seem to be as sold that this is going to make a big difference when it comes to the Democrats in the Senate.
The Senate Majority Leader is very gifted in a lot of ways, and one is hyperbole. This makes, for markets, first of all, and for the day-to-day running of the Senate, this makes virtually no difference. Think about it this way. The Senate was already 50 plus one, the vice president. Now it's 51 without the vice president, but still the Senate operates much more as 100 CEOs that operate in coalition with one another, depending on the issue, than any kind of fixed party line votes, generally speaking. And, so by and large, things aren't really going to change very much. You still have to cobble together the votes. And not only do you have to cobble together majority votes just to get things out of committee, you have, for almost everything, you have to cobble together a 60-vote supermajority in the Senate. And to do that, you need not only all your people, but you need a bunch of Republicans too. So I wouldn't look for anything much different to change. For markets, it's going to be a little bit of a different look, though. Markets can continue to expect centrists in the Congress, Democrats and Republicans alike, to shoot down nominees that are too progressive, too liberal, just as we saw at the Fed and at banking regulators over the last 2 years. But there's not going to be, and that's the good news for financial services companies, for example. But on the other hand, there's not going to be the unanimity necessary to really try to stop things that the regulators are doing either. So, regulators having a freer hand is something that's going to cause financial services firms a little bit more headache. So this is a mixed blessing.
I mean, Terry, bottom line, just more gridlock. Is that what we're looking at?
Akiko, good morning. Yes, I think so. I think what you have is three things here. You have domestic gridlock on pretty much everything. You have a grudging consensus on basic fiscal matters, by which I mean that the government continues to get funded on an annual basis, pretty much as it's done now. And finally, you get continued unanimity and bipartisan unanimity on foreign policy. So things are not going to change with respect to Russia, with respect to Ukraine, with respect to China, just to name three. And I think that's where we are.
And in terms of the narrative between now and 2024, how much does this change things?
I don't think it really changes things a lot. I mean, what you've got is, I don't think either party can really take much good away from the Georgia election. Reverend Warnock increased his total a little bit. Mr. Walker's total declined a little bit. But you had a situation where, Warnock ran at the top of a Georgia ticket that was deflated down ballot by gubernatorial candidate Stacey Abrams, who was a great hope for the Democratic Party over the past few years, and the like. Similarly, Walker was at the bottom of the Republican vote-getting ticket, with Governor Kemp really doing very, very well in the gubernatorial election. So I think things get more muddled. One thing I always get asked about is, is this going to mean that, Senator Manchin has less power, less control? No, he and Senator Sinema and the other centrists that are out there have the same ability that they've always had to try to pull the Senate in their direction. That hasn't changed. And if anything, to your question about 2024, Rochelle, Senator Manchin's up for re-election. Senator Sinema's up for re-election. They don't have any incentive to do anything else other than pull things in their direction. I'm sorry.
Specifically on Georgia, though, these claims of Georgia now being a battleground state, now that Raphael Warnock has run 2 runoff elections, I mean, you think that's overstated?
No, I don't think it's overstated. I don't think it's really about Reverend Warnock, though. I think what you've seen is in the past few elections is a huge turnout in Georgia, and you've seen, if anything, a move towards Georgians wanting candidates that will represent to them well, engage with them well, and or that are focused on the day-to-day business of government. Kemp barely won 4 years ago, and in electoral terms, did very, very well last month. Warnock really pretty much squeaked through. I mean, nothing negative about that campaign, but pretty much squeaked through. And you're always going to get against a weak candidate in Walker, and you're going to get if they get stronger candidates on the Republican side in Georgia, as Kemp shows you, Republicans are more than capable of winning there.
Yeah, a lot of Republicans asking this morning whether, in fact, the results would have been different. They've had a stronger candidate on the ticket there. Terry, good to talk to you today. Pangea Policy founder Terry Haynes joining us there. Coming up on the other side, pain points. Last week's blowout jobs report left lingering questions about the real state of the labor market. Like what happens when the thousands of tech layoffs we've seen spread to the rest of the economy? All of that is coming up next.
It's undoubtedly been a rough year for big tech, especially for workers in the space who've been let go or are bracing for more layoff announcements. In the US, more than 88,000 workers in the sector have been laid off as part of mass job cuts so far in 2022. That's according to Crunchbase. Now, many company execs have attributed the widespread downsizing to the hiring frenzy that happened during the pandemic. So what will be the impact on the labor market? Well, with us now to discuss is Annalise Vance-Sherman, regional labor economist at the Washington State Employment Security Department. Thank you for joining us this morning. So I first want to get your take on what we're seeing in terms of the layoffs and how much do you expect this to continue? Is this something we can continue to expect into the first half of next year?
Well, I think one of the first things to understand is some of the constraints in the data. A lot of the layoff announcements that were made were in the last week of October and early November. But the data that we're looking at in the current jobs report references the second week of October. So this is still lagging behind. Now, that said, we're still seeing a strong labor market, a 3.7% unemployment rate, and overall continuing to add jobs. But the question really comes, what will next month's report tell us, because for the most part, it's not going to be captured in this report.
Annalise, you look at the regional economy there. Obviously, Amazon, a huge employer. We've already gotten reports of 10,000 layoffs. Some reports suggesting the number could be double that. What's been the impact on a local level?
Well, again, this is one of those challenges where we're chasing the data to figure out what's going on. We have some official WARN notices, that's worker advisory and retraining notices for Meta and for Twitter in Washington State, and those have already gone through the process. We've got the documentation for that. We know that there are large-scale layoffs happening at Amazon, but when we look at those numbers, it's still a relatively small proportion of jobs. And I don't mean to downplay that. Of course, this is still a large number of jobs, large number of families and individuals impacted by these layoffs that are happening. But so far, the numbers show a relatively small, about 3% drop in employment. So, of course, in a place like Seattle, where we do have a lot of high concentration of tech jobs, that is going to have an impact.
Well, and that's my follow-up there. I realize that you've got to crunch the data here, but given just what a tech hub Seattle is, are there enough openings, for example, to be able to support some of these cuts that have come through major employers like Amazon?
We have yet to see that, but one thing that we are seeing is in Washington, as the rest of the country, we're seeing record numbers of job openings. We're seeing a lot of voluntary quits, a lot of these measures that reinforce the idea of a strong economy. We know that there are a lot of different employers that might not have the same big names that are looking for that skill set. When we're looking at tech, it's hard to measure because this is a skill set that's spread across a number of different sectors. Of course, a lot of them are concentrated in sectors such as the information sector, or in the case of Seattle with Amazon in retail trade. But we also have a lot of hospitals looking for the skill sets that these employees bring. A lot of different, public sector and private sector employers, including smaller employers that might have had difficulty competing, that will likely absorb a lot of these jobs.
So, Annalise, just quickly before we run out of time, what is the best gauge then to really get a sense of what's happening with tech sector layoffs? What data are you looking at?
Primarily, I'm looking at the lagged data. We are going to always have this lag built into the data. But when I'm looking at the monthly reports, I think one thing that was interesting in Washington State, I was surprised to see that the October report did show some layoffs in the information sector, which I was not expecting to show up until the November numbers were published. So we have seen a downturn already in these numbers that's telling us that these layoffs are in process. They are indeed happening. We have documentation through WARN notices that these layoffs are happening. One other measure that we looked at very closely during the pandemic was unemployment insurance claims data. That's weekly, so we tend to have, with the more frequent cadence, we could look at that as a leading indicator, but we're not going to be able to rely on that this time around. And the reason is that a lot of the jobs do come with severance packages, and so we won't be able to use that as a leading indicator. So right now it's going to be a difficult one to measure because they're coming from a number of different sectors. And we're not really going to have unemployment insurance showing up until perhaps later, if at all, as hopefully that cushion helps provide people that bridge into their next job.
Yeah, a bit of a noisy picture there, sort of similar to what we're seeing nationally. Annalise Vance Sherman, regional labor economist at the Washington State Employment Security Department. Good to talk to you today. Well, coming up, choose Twitter 2.0 or find another job. This may be a simple choice for immigrant workers who need their job to stay in the U.S. But if you've already been laid off, then what? We discuss with an immigration attorney next. Well, back in November, Elon Musk gave Twitter employees just 36 hours to decide if they wanted to commit to an intense work ethic or head for the exit. For many, it might have been a no-brainer. It's not the case for immigrant workers, and especially those employed under the H-1B visa program. Many tech groups have workers under the status, which begs the question, what happens to them at a time of heavy layoffs? We're joined by Tamina Watson, an immigration attorney and founder of Watson Immigration Law. Tamina, we're talking about Twitter today, but obviously this applies to so many tech companies. We're talking about Amazon as well as Meta and many others. As we've gotten the reports of these layoffs, how has that increased your case count or caseload?
Well, so thank you so much for having me. I think this is a very important issue that people don't really understand. When somebody's working in the United States on a visa, they have to continue to work. Otherwise, they would be unlawfully in the United States. So anybody who is looking at perhaps being laid off soon, they need to start thinking about it immediately. What will be their options? But if people have already been laid off, they only have 60 days to stay in the United States under what's called a grace period, or they have just about enough time on their visa status. So if somebody has status, their visa expires December 15th, for example, they will only have that amount of time, not 60 days. So time is of the essence for people who are looking at layoffs or have been laid off already.
So Tamina, say you're on an H-1B visa and you get this layoff notice, what should be your first steps?
Well, the first step would be to ask whether they could ask for extra time. Could they perhaps negotiate any paid time off to be paid at the end of their time? Some negotiations have to work. They could also ask perhaps to be moved around within the company and have amended visas. So that's the first thing I would ask people to do, is be creative within the company, see if there's wiggle room. The other thing that people don't necessarily always understand is you can have a part-time visa, H-1B. So for example, if an employer is saying, I can't pay the salary that we promised, perhaps there could be a part-time option. So explore all the options within that company. But what will ultimately happen is they will be laid off, because that's what companies are doing. And so if that happens, they must actually try to find another job within 60 days.
Tamina, I'm thinking back to even before these layoff announcements, we had a number of tech executives who were pressuring the Biden administration to really clear the backlog that still exists on processing H-1B visas because of the slowdown during the pandemic. To what extent has that really added to the situation for those who are trying to stay within the country without a job? I mean, can you talk a bit about that and how that has sort of compounded the challenges for those who are trying to stay?
Well, I think, Akiko and Rochelle, you're asking some very important and complicated questions. And these are, they complicate the people's lives in very many different ways. So when we talk about backlogs, there are different types of backlogs. There is the H-1B backlog of just processing cases if the government hasn't received their premium processing fees. But there is also a green card backlog. A lot of people who are on H-1Bs, let's say from China or India, they would be in the line to get a green card. And those backlogs are 10, 15 years long. And so the H-1B visa allows them to stay here while they are in the backlog. So if those backlogs are not cleared and the job goes away, the green card application also is in jeopardy. And when you think about somebody who has actually been laid off, it's not just one person's life at stake. It's their spouses, it's the children who were probably born in the United States, children who, came here when they were young and they know nothing but America as their homes. It's going to be uprooting entire families. So it's very important to understand that when somebody is being laid off and they're on a visa, the complication is just many-fold, and it's often invisible and too complicated to even explain for the laid off person to explain.
So then when we think of domino effects, I mean, if you think of the share of tech workers who are on H-1B visas and what that means when you don't have this talent in an economy, what are some of the things that people should really consider in how they think about H-1B visas and their value?
Well, Rochelle, I think that's a really important question too, because people don't really understand what the skilled immigrant workers are doing for this country. If somebody just picks up their phones, they'll see that the network, the hardware, the software, all of those things are actually being maintained by a large proportion of immigrant workers. If you think about doctors and the medical profession, there are a lot of people on H-1B visas. And, you know, the contribution that they are making to the economy is profound. The other thing that happens with H-1B workers is that there is a multiplier effect. For one particular H-1B worker, there are 7 non-visa holding, jobs that are created, because that person will need an accountant, a doctor, perhaps a gardener. There are many different types of jobs that are created from one H-1B worker. So there are many different types of contributions that happen. Some are visible and some are not visible. But the economic contribution that happens to H-1B workers is incredibly important, because we just don't have the talent that is necessary.
And certainly you want to stay competitive and you don't want the talent just leaving. A big thank you there to Mina Watson, immigration attorney and founder of Watson Immigration Law. Thank you for joining us this morning. All right, coming up, your driverless Uber is on its way. If you think the city of sin needed more adventure, you can now hail an Uber robo-taxi in Vegas. But now there's someone behind the wheel, but that's not the long-term plan. We'll discuss next.
Well, Uber and Motional are announcing the launch of a public robo-taxi service starting today in Las Vegas. For the first time ever, public Uber riders can now hail a fully autonomous ride. We've got Yahoo Finance's Ali Garfinkel on this story there. Ali, I mean, how significant is this development and what kind of demand are we talking about?
It's pretty significant, Akiko, and it's worth saying that in terms of demand, that how this actually works is kind of a game of chance a little bit, because that was my first question. How on earth does this work? The answer is you actually go to your Uber app, you go ask for an Uber X or a Comfort Electric, and it might match you if you're in Las Vegas with an autonomous vehicle. Now, there is a backup driver still. The goal is eventually that there won't be, but the gist is, you go on the app, you will have to opt in. They won't just give you an autonomous vehicle you didn't ask for, and then you can open the car door with your app. Now, they do have a history here, Akiko, which is one of the things that's kind of worth noting. Uber, though this partnership with Motional officially dates back to October, they have a 10-year commercial partnership in place. Motional's been working with Uber for some time, and Uber's efforts in autonomous vehicles actually date back to about 2015. That said, it hasn't exactly been a straight line for them. It's worth saying in 2018, an Uber test vehicle was actually involved in what's believed to be the first death attributed to self-driving technology. So it hasn't been a straight line. They had this autonomous unit that they sold to Aurora a couple of years ago. They've been messing around with autonomous vehicles for a long time, but founder Travis Kalanick kind of led that charge, and the current CEO has also talked about it as being really important to the company. So my take right now, Akiko, is they're all in. If you're in Vegas, there is going to be a safety driver if you want to take an autonomous ride, and look for plans to expand. They've said they want to expand here to Los Angeles.
Ali, with that said, Waymo has kind of been ahead of the game when you compare them to where Uber is. They've been offering these types of taxi services to the Phoenix airport. They've already got a trial going here in Los Angeles. I mean, how does Uber stack up against that in terms of the competition?
We'll have to see, Akiko. I think that it is probably disadvantageous for Uber if they can't necessarily guarantee you're going to get an Uber ride. They declined to tell me exactly how many autonomous Motional vehicles are going to be on the road in Vegas. So we'll have to see. I think that's one of those time will tell things, but there's no question that Waymo has a leg up.
Well, first in, we'll see if they can take advantage of that. Ali Garfinkel there reporting for us. All right, coming up, islands in the stream. Not just your favorite Dolly Parton song, but your favorite streaming service, once known for being commercial free, changing their tune. The latest on the industry next. Streaming services, once known for being commercial-free, still changing their tune, starting with the upcoming launch of Disney's ad-supported tier, and Netflix's co-CEO also touting more plans for ads. Well, for more on this new trend, let's bring in Yahoo Finance's Alexandra Canal. So no more freebies.
That's right, Rochelle. A lot happening in the streaming space, specifically when we talk about ad-supported. Disney's ad-free tier is going to officially launch tomorrow on Thursday at a price point of $7.99. That means that Disney's original plan without ads, that's going to cost $3 more, $10.99. And according to a new study from Kantar Research, about 1 in 4 Disney Plus subscribers will trade down to that ad-supported tier. So that translates to roughly 46 million out of the total subscriber base for Disney Plus, which is 164 million. Now, of course, this ad tier comes just 1 month after Netflix's own ad-supported version, the Netflix ad tier costing $6.99, so $1 less than Disney's, and pretty competitively priced when we look at the streaming landscape, specifically those ad tiers. And like you said, we did hear from Netflix co-CEO Ted Sarandos yesterday speaking at a UBS conference, and he said just like Netflix has multiple premium tiers, you can expect to see multiple ad tiers over time. So that's something to keep an eye on. I will say that there are a few downsides if you subscribe to the ad tier. For example, you cannot download certain shows or movies due to technical complexities surrounding the ads. In addition, some programming is not available through this ad tier. Sarando says currently about 90% of content is available. He's hoping to up that number over time, and that's due to a variety of restrictions that Netflix is still figuring out. But overall, really interesting to see Netflix doubling down on ads, considering out of all the streaming giants, they were the ones that were the most resistant and the most hesitant.
Allie, can we talk about Wednesday? I mean, I'm going to say that this is a Netflix show that I saw the trailer and I just said, no, pass. I'm not going to watch this. And now it is one of the all-time most popular shows.
I agree, Kiko, and I think a big part of this is word of mouth. If you just look at the numbers here, for the week of November 28th, the show racked up over 411 million viewing hours. That brings its grand total to 752.52 million hours viewed. That's according to Netflix, and it makes this series the third most popular English language show of all time, right behind Stranger Things Season 4 and Monster, the Jeffrey Dahmer story. Many believe that this will inch into that number 2 spot and defeat Dahmer, given where things are currently trending. Of course, the number 1 show of all time on Netflix is still Squid Game, so I'm not quite sure that Wednesday will rack up the numbers to beat that one, but still, it's so impressive. And if you look at some of the original programming that Netflix has released this quarter, it's not just Dahmer and Wednesday, but also The Watcher has been really successful. On December 28th, we'll see that Glass Onion, Knives Out sequel. So it's going to be interesting to track that and see how that translates to the fourth quarter earnings that we'll get in 2023.
Yeah, incredible to think that the Addams Family still is a draw.
Yes.
Glass Onion is one I'm definitely looking forward to watching.
It's
I'm
good.
still behind there, but I'll do some catch up over the weekend. Allie Canal, as always, thanks so much for bringing that to us. Well, let's do a final check of the markets with the S&P 500 on track for a 5th straight day of declines. That is the worst streak since mid-October. You're taking a look at all 3 major indices firmly in the red right now, with the Dow down 21 points and the Nasdaq down 54, continuing to see tech under pressure there. But of course, a lot of concerns weighing on the markets right now. Rochelle, as we pointed out, investors still firmly focused on the Fed with that FOMC meeting coming up next week. That does it for Rochelle and I in the 11 a.m. Eastern hour. We're going to be right back here again tomorrow. Thanks so much for watching.